An algorithm just scheduled your shifts, measured your keystrokes, and flagged your bathroom break as a productivity leak. You are now officially a biological asset being managed by code, and it does not care about your mortgage. Welcome to AI Market Mint.
Turn AI into income. Turn knowledge into freedom. Your digital HQ for smart wealth creation.
Look, the era of, charming your boss for a promotion is completely dead.
Oh, absolutely dead.
Right. I mean, we are looking at a corporate landscape where navigating human office politics has just been entirely replaced. You're no longer dealing with a person in a corner office who maybe has a bad Monday or just happens to have a soft spot for your sense of humor.
Yeah, you're dealing with a mathematical optimization function.
Exactly. A function that views you entirely as a depreciating line item. And listen, if your daily output is predictable enough to be tracked, well, it is structured enough to be financially replaced.
It's a brutal transition. And, the psychological reality of this is hitting the workforce really hard right now. People are genuinely waking up in cold sweats because they're slowly realizing their direct supervisor is effectively a server rack in some remote data center.
Which is terrifying for them.
Right. They're looking around their home offices. They're staring at their company-issued laptops and recognizing that the machine is watching them with a level of scrutiny that, honestly, no human manager ever could.
And it does not care about your rent. It doesn't care about your inflation-adjusted grocery bill. It simply processes your output. I mean, the comfort zone is exactly where middle-class wealth goes to die. I talk to people every single day who are treating this massive macroeconomic shift like it's just, some temporary corporate trend.
Like it'll just blow over.
Exactly. Something that will eventually blow over once the hype dies down. They think their specific job has some magical, intangible quality that permanently protects them.
Well, it's a natural defense mechanism. To really understand why it feels so dehumanizing, you have to look at what the enterprise AI is actually doing beneath the surface. Because it's not just looking at a quarterly performance review spreadsheet anymore.
Oh, no, not even close.
Right. It's actively, constantly ingesting your daily Slack messages to run sentiment analysis on your communication style. It's tracking your email response times down to the millisecond.
In the millisecond.
Yeah. It is monitoring your ticket resolutions and then correlating them against global benchmarks to calculate your exact real-time market worth.
It completely strips away all human bias, all those little corporate pleasantries. Algorithms do not care about your 5-year tenure. They just don't.
Right.
They don't care about your fierce loyalty to the company brand or, how many weekends you worked last year during that one major product launch. They care exclusively about your daily yield and your cost efficiency today.
Exactly. When a human manager likes you, you have this massive emotional buffer. Think about it. If you have a bad week, or if you're dealing with a personal issue at home, or even if you just make a costly mistake, that human connection protects your position.
Right. The manager covers for you.
Yeah, they might say, well, they usually do great work, let's just give them a pass. But with an algorithmic manager, you just get a raw efficiency score. If that fractional score drops below the acceptable threshold, well, your income stream is immediately threatened.
Instantly.
Right? There is zero empathy in a neural network. It simply calculates that your operational cost has temporarily exceeded your output value.
Yet most average workers are living in complete denial. They falsely believe that the human resources department is, going to step in to protect their humanity. They view HR as the shield against corporate cruelty.
Which is just the ultimate systemic irony. Human resources is the exact department signing the multi-million-dollar vendor contracts for this surveillance software.
Yeah.
HR departments are not your therapists. Their core mandate is risk mitigation and resource optimization for the enterprise.
Yeah.
They are buying this software specifically because it completely removes managerial friction.
It removes the need for difficult, awkward conversations. It removes the threat of subjective bias lawsuits entirely.
And it provides a perfectly neutral, unassailable data trail. If they need to terminate someone, they don't have to build some subjective case over 6 months. They just point to the dashboard.
Look at the numbers.
Right. But the emotional toll on the individual contributor, the person on the other side of that dashboard, is staggering. You're constantly performing for a relentless machine that never sleeps, never takes a lunch break, and never experiences decision fatigue.
You are trying to compete against the speed of light and infinite processing power. I tell people this all the time. If your entire financial strategy for the next decade relies on simply trying to outwork an algorithm, you are playing a mathematically rigged game.
You can't win.
No. You are going to lose your health, your sanity, and eventually your income.
The chronic stress that workers are feeling right now, that low-level persistent dread, it comes from a complete and total lack of control over their own career trajectory. You cannot negotiate your salary with a digital dashboard.
Good luck trying.
Right. You cannot plead your case or explain your personal circumstances to a machine learning model. It simply looks at your data inputs, measures your outputs, and flags you for immediate termination review.
Which means your current household cash flow, the absolute foundation paying for your life, is entirely dependent on a black box. A black box that you don't even possess the security clearance to understand, let alone audit. Listen, if you do not own the capital or control the code, you are nothing more than an input metric to the corporation.
And if you're sitting there hoping your specific company or, your highly specialized industry is the rare exception, you are actively choosing to be a victim of the next massive technological cycle. It's a harsh realization. It really shatters a lot of professional egos.
It needs to shatter egos. That is the necessary psychological pain you have to feel before you can successfully restructure your income. You either learn to aggressively leverage this math, or you get completely crushed by it. But look, to really grasp the magnitude of what we're dealing with, we need to look at how society designed this economic model in the first place. Because this didn't just happen overnight.
Oh, far from it.
Yeah.
This isn't just about some new generative model being invented last year in a Silicon Valley lab. This is the culmination of decades of systemic design. It is the absolute logical endpoint of capital allocation since the dawn of the Industrial Revolution.
Let's trace that history, because if you do not understand the historical incentive structure of a corporation, you cannot possibly predict its next move. Since the late 1800s, the primary goal of the enterprise has always been to separate the fragile, unpredictable human worker from the core production process.
Think about Frederick Winslow Taylor in scientific management. Taylorism was all about bringing a stopwatch onto the factory floor. The traditional assembly line perfected this for physical, manual labor.
Right.
You stood in one specific spot, you tightened one specific bolt, and the mechanical line moved at a predetermined pace. Executive management controlled the exact speed of the line, completely dictating your physical output. You were, well, just a biological cog.
But knowledge work was entirely different. As the economy transitioned from manufacturing to services and information, things got incredibly messy. Knowledge work was historically chaotic and highly unpredictable. I mean, you couldn't easily measure exactly how long it took a human brain to write a thoughtful strategy email or design a complex marketing graphic or solve a massive global logistics problem.
Because it was messy and unquantifiable, companies were basically forced to hire massive, expensive layers of middle management just to oversee the chaos.
Just to watch people work.
Exactly. That's where the entire culture of the modern office came from. We ended up with millions of middle managers whose only real job was to observe other people working and subjectively guess their productivity levels, usually based on who stayed at their desk the latest.
It was an incredibly expensive, highly inaccurate, and just deeply flawed system of tracking human capital. It was a massive financial drag. You had Fortune 500 companies paying bloated six-figure salaries to administrative personnel who produced absolutely nothing but, subjective performance review spreadsheets once every 12 months. Wall Street tolerated it because there was no alternative. But then the digital transformation aggressively accelerated.
Right. Once every single action you took on a company device became perfectly logged and categorized, your emails, your calendar invites, your cloud software interactions, your CRM updates, it created this immutable, searchable data trail of your exact professional behavior.
It left a footprint.
Yeah. The office became digital, which meant it finally became measurable.
And once it became measurable, capital markets eventually realized that human middle managers were just slow, incredibly expensive algorithms weighed down by emotional baggage. Wall Street looked at these bloated corporate balance sheets, especially after the era of free interest rates ended, and demanded much leaner operations to maximize shareholder returns. I mean, why pay a human manager $70,000 a year to clumsily manage 10 people when a localized software product can monitor 1,000 people with flawless precision for a fraction of the total cost? It is basic, undeniable resource allocation.
Wait, Ali, algorithmic arbitrage sounds technical.
Yeah.
What does that actually mean for a normal person?
Simple. It just means replacing expensive human decisions with cheap software calculations to pocket the difference. Imagine it like firing a $10,000 accountant and buying a $50 calculator to keep the extra cash.
That is the perfect way to look at it. The corporate system is functioning flawlessly according to its design. It's specifically engineered to squeeze maximum output from the absolute minimum input.
Oh,
And algorithmic management is just the sharpest, most ruthless tool they have ever built to accomplish that goal. Smart capital relentlessly searches for inefficiencies to exploit and eliminate. And for the last 20 years, the single biggest financial inefficiency in the global market was unmeasured knowledge worker time.
and now that time is perfectly measured, the historical lens shows a massive phase shift from managing physical effort on an assembly line to optimizing digital outputs in the cloud. Look, the algorithm is the new, unforgiving factory foreman holding a digital stopwatch. Every single minute you spend staring blankly at your screen is tracked as idle time by the camera and the keystroke logger. The system instantly classifies your hesitation as corporate financial waste.
The crucial thing to internalize here is that the enterprise system does not actively hate you.
Doesn't know you.
Right, it doesn't wish you harm. The system simply does not care about you at all. It only registers yield, velocity, and profit margins.
Which means if you are still trying to play the corporate career game using the outdated rules from a decade ago, you are going to get absolutely slaughtered in the market. You are bringing a paper resume and a firm handshake to a high-frequency data fight. So the obvious question is, why are so many capable, highly intelligent professionals still doing this?
Well, it comes down to a massive psychological blind spot. It's the illusion of exceptionalism combined with the extreme danger of effort justification.
Explain that, because I see people making massive financial miscalculations based purely on cognitive arrogance. Like, everyone secretly thinks the person sitting in the cubicle next to them is entirely disposable, but they deeply believe they're uniquely valuable to the firm.
Exactly. Let's look at a fictional example to make this psychology real, because we see this exact profile all the time. Think of a mid-level supply chain analyst making $85,000 a year. Let's call him Rahul. So Rahul works at a mid-sized logistics firm.
Right. And Rahul genuinely thinks his position is permanently safe. He occasionally plays golf with the vice president of operations. He knows the first names of everyone working down in the regional warehouse. He knows their kids' names. He foolishly thinks his corporate relationships are his competitive moat. He deeply believes his accrued social capital makes him entirely immune to algorithmic replacement.
Yeah, Rahul thinks the subtle human nuances of his daily logistics job cannot possibly be quantified by a machine. I mean, his primary responsibility involves handling delayed global shipments. When a ship container gets held up at the port, Rahul spends roughly 3 hours a day making phone calls to vendors, smoothing out relationships, and manually updating delivery timelines in a spreadsheet.
And he feels great about it.
He feels incredibly productive. He feels essential. The phone is ringing, he's talking, he's stressed out, therefore he must be important.
But then the parent company quietly installs an AI-driven predictive logistics platform. And let me tell you, the platform does not play golf on the weekends. It does not care about Rahul's charm or his warehouse jokes. It strictly evaluates global supplier data, transit times, maritime weather patterns, and inventory turnover ratios.
Right. And the AI immediately flags Rahul's 3 hours of daily vendor phone calls as a systemic, expensive inefficiency. The algorithm quickly determines that if it automatically reroutes those specific global shipments based on real-time weather and traffic data 2 days before the delay even occurs, well, Rahul's daily crisis management phone calls are completely unnecessary.
The problem is solved at the source before Rahul even picks up the receiver. Rahul's deep psychological bias told him that extreme effort equals extreme value. He tragically confused daily activity with actual economic accomplishment. He thought grinding away at the phone, sweating the details, and looking stressed made him indispensable to the company. He completely failed to realize that the free market only pays for solved problems, not for human sweat.
It's not that workers are soulish. Our brains are literally hardwired to associate physical exhaustion with value. For 10,000 years of human evolution, if you spend more energy and sweat more, you gathered more food. We are biologically programmed to trade effort for security. But that evolutionary programming is betraying us in a digital economy.
Look, I get the biology, but the market does not care about our evolutionary programming. The market cares about yield. When the artificial intelligence solved the underlying problem at the data source, Rahul's entire role instantly became an obsolete corporate expense. And instead of adapting, capable people in this situation often pivot to extreme defensiveness. They double down on the very behavior that is getting them replaced.
Wait, Ollie, sunk cost fallacy sounds technical. What does that actually mean for a normal person?
Simple. It just means refusing to abandon a bad strategy because you have already invested too much time or money into it. Imagine it like staying in a miserable relationship just because you have already been together for 5 years.
That is exactly what happens in these corporate environments. People suffer from this persistent illusion of complexity. They think their daily administrative tasks are highly sophisticated simply because they feel exhausted and stressed while executing them. But stress is absolutely never a metric of true market complexity. It is usually just a metric of personal inefficiency.
If a machine learning algorithm can successfully map your daily business decisions into a clear decision tree, your job is already functionally redundant. But Rahul gets incredibly defensive. He tries to manually prove the algorithm wrong. He starts working longer, uncompensated hours just to manually check the AI's math, hoping to find a flaw so he can justify his existence to the VP.
Which is financially disastrous. You cannot successfully outwork a processor that runs millions of complex calculations per second. You're just rapidly depreciating your own physical and mental health for zero financial return. It's a stubborn refusal to accept the new economic reality.
People desperately cling to their original job descriptions. They think if they just keep doing exactly what they were hired to do 5 years ago, the company owes them a comfortable living forever. Let me be brutally honest. The global market owes you absolutely nothing. The exact moment your cognitive bias convinces you that you are fundamentally safe, you have officially stopped adapting.
And standing still right now is a guaranteed financial death sentence. We desperately need to break this widespread illusion of exceptionalism. To an algorithmic manager, you are simply a line item on a corporate profit and loss statement. To really understand why the company is aggressively making these moves, we need to strip away all human emotion and look at the brutal, undeniable mathematics of corporate finance.
The underlying math is lethal. It is a compounding financial squeeze on the traditional W-2 employee, and most people cannot see the jaws of the trap closing around them. Let's break down exactly why major corporations are rushing at breakneck speed to implement this algorithmic management layer. Look at the basic foundational cost of keeping a traditional human employee. Let's say you earn a solid base salary of $100,000 a year. That is just your top line number.
Right, and that top line number is highly deceptive.
Yeah.
Because the company is actually paying massive employer payroll taxes on your behalf. They're paying expensive, constantly rising healthcare premiums. They're funding generous 401k matches, paying for real estate overhead if you're in an office, and spending thousands of dollars annually in software licenses. Salesforce, Microsoft 365, specialized industry tools just for you to securely exist in their digital ecosystem.
Your true operational cost to the firm is easily closer to $140,000 annually. And you must heavily factor in the opportunity cost of that tied-up capital. That $140,000 is liquid capital the business has trapped in a highly depreciating, unpredictable asset.
Which is a human worker. Humans naturally depreciate in daily efficiency.
We die.
We get physically tired by 3 p.m., we get sick, we suffer from severe burnout, we take vacations. A well-trained enterprise algorithm scales infinitely across the entire global organization, and its marginal cost of operation rapidly approaches absolute zero.
If an executive can successfully deploy an AI management layer for $50,000 a year that seamlessly optimizes a 10-person department down to 3 essential people, they are effectively printing free money. They permanently eliminate 7 full-time salaries. Let's do the exact math on that move, because this is the math happening in boardrooms right now. 7 displaced workers at a $140,000 total cost each. That is nearly $1 million in liquid capital, completely freed up immediately, year over year.
And the executive board does not leave that newly liberated $1 million sitting in a low-yield commercial savings account, losing value to inflation. They aggressively reinvest it at their required internal rate of return. Wait, Allie. Cost of capital sounds technical. What does that actually mean for a normal person?
Simple. It just means the minimum return a business must earn to justify spending money on you. Imagine it like the interest rate a bank charges. If an investment does not beat that rate, it is a mathematical failure.
Right. So if their corporate cost of capital is exactly 8%, and they can confidently generate a 15% return on reinvested operational cash by funding new product lines or acquiring competitors, that freed up $1 million compounds incredibly aggressively.
Oh, massively.
They just increase their total enterprise valuation massively with one software integration. They clear their financial hurdle rate incredibly easily by firing you and deploying an algorithmic workflow.
It is a highly asymmetrical bet with almost guaranteed financial upside for the institutional shareholders. The risk is incredibly low for the corporation. But meanwhile, look closely at your own personal financial math. If you are that displaced, replaced worker, your primary income stream goes to zero instantly.
But your monthly household liabilities stay painfully fixed.
They don't stop.
No, your expensive 30-year mortgage does not pause. Your car payment is due. Your monthly grocery bill is rapidly rising because macroeconomic inflation is quietly eroding your remaining purchasing power. You're caught in a lethal compounding financial squeeze.
And here is the truly insidious part. Even if you miraculously keep your job under the new algorithmic manager, you are still mathematically losing over the long term. The AI permanently caps your financial upside. It measures your hourly productivity so precisely that you can never overdeliver enough subjective value to demand a massive life-changing raise.
It turns your highly skilled labor into a perfectly priced, heavily monitored commodity. If you are producing exactly 30 units of digital value an hour, the system ensures you are paid exactly for 30 units, not a fraction of a cent more. There is zero premium allowed for perceived effort, past loyalty, or creative potential.
Not at all.
When your professional labor is perfectly commoditized by a machine, you lose all personal pricing power. You cannot aggressively negotiate against a digital system that knows exactly what the fractional replacement cost of your specific output is on the global open market.
And do not forget the brutal impact of traditional taxes on the W-2 employee. You are consistently taxed at the highest possible marginal rates.
Yeah.
You generate linear income, the government immediately takes 30% or more off the top, and you are forced to survive and build wealth on the remainder.
Meanwhile, the corporation buying the AI technology actively writes off the entire software expense against their corporate taxes. They use pre-tax capital to purchase the exact tools that permanently suppress your post-tax wages.
It's unbelievable.
The capital owners are rapidly compounding tax-advantaged wealth, while the traditional wage earners are trading finite, heavily taxed hours against an infinite, untiring machine.
The hard math simply does not support a traditional, comfortable middle-class existence anymore. You cannot save your way to wealth on a capped, monitored salary while inflation runs hot. You just can't.
Which brings us to the real consequences, the massive generational fork in the road that every single professional is standing at right now. There are two distinct paths forward, and you are currently walking down one of them whether you realize it or not. There's the managed class, and there's the leverage class. Let's look at Path A, the default passive employee.
Path A is where you choose to stay a passive participant in the economy. You quietly accept the new algorithmic manager. You try to frantically optimize your bathroom breaks just to keep your daily efficiency score out of the red zone. Your daily life becomes a dystopian, high-stakes stress test. You exist purely as a biological gear in a massive digital machine.
You'll continually work harder for less real purchasing power, constantly terrified of the next unannounced software update that might redefine your daily quota. You slowly but surely lose all professional autonomy. The algorithm starts aggressively dictating not just your schedule, but exactly how you write your client emails, how you structure your code, and exactly what script you use to speak to dissatisfied customers on the phone.
And eventually, when the foundational AI models get just good enough, it entirely replaces your position. Path A inevitably ends with you staring at a generic severance package generated by an automated HR portal.
Yeah.
The hidden psychological toll of staying on Path A is absolutely devastating. It breeds deep chronic anxiety. You spend your weekends endlessly worrying about your Monday productivity dashboard instead of building a legacy, acquiring actual assets, or enjoying your family.
Now look closely at Path B, the strategic allocator. Path B is where you aggressively refuse to be the monitored input. You step entirely outside the corporate optimization loop and start dictating the rules of your own economy. You treat yourself strictly as a highly efficient micro-enterprise.
You completely stop selling your finite, easily measured time to a single corporate buyer who obsessively tracks your keystrokes. Instead, you start independently leveraging the exact same powerful AI tools the Fortune 500 corporations are currently using, but you use them to infinitely scale your own personal output. You transform into a one-person leverage machine.
Let me give you an example of Path B. Think of someone we'll call Sarah. Sarah was a mid-level financial analyst trapped on Path A. She was spending 50 hours a week manually pulling CSV files, running pivot tables, and formatting weekly revenue reports for upper management. She was stressed, underpaid, and her company just installed monitoring software to track her active window time.
So Sarah made the transition to Path B. On Path B, an AI doing 90% of the heavy lifting does not get you fired. It makes you incredibly rich because you personally own the final output. Sarah quit the W-2 role. She took the exact same skills, but instead of doing the manual data entry, she set up an automated data pipeline using AI to clean, analyze, and format the data. She then sold the final polished reports back to 5 different companies simultaneously as a premium service.
She captured the massive profit margin herself instead of handing it over to an employer. If you do not actively own the system producing the value, the system will eventually own you. We have seen ambitious people transition from path A to path B in under 6 months. They go from burnt-out, micromanaged employees to highly independent operators, effortlessly handling 5 lucrative corporate clients simultaneously.
They completely stopped playing the traditional volume game, trying to bill more hours, and started playing the high margin value game. They permanently detached their personal income from their logged hours. Look, the middle ground is completely dead.
It really is.
The algorithm killed it. You either learn to tell the machine what to do, or the machine will permanently tell you what to do. So we need to shift from theory to exact execution. How do you actually cross over to path B today and permanently shield yourself from this incoming algorithmic slaughter?
It requires a strategic solution, a very specific step-by-step framework to achieve financial sovereignty. And it starts with a violent, immediate mindset shift. You have to entirely kill the passive employee mentality. You are no longer a submissive person blindly applying for a traditional job, hoping someone picks your resume out of a stack of 500. You are a sovereign business aggressively offering a specific, highly leveraged solution to the open market.
You have to permanently stop identifying with your fragile job title. You are absolutely not just a copywriter, a front-end coder, or a financial analyst. Those are manual tasks. You are a strategic human director who leverages AI systems to generate extremely high-value market assets. If you stubbornly cling to your outdated identity as a manual worker in a rapidly digitizing field, you are completely done.
You have to view AI not as a competitor threatening your livelihood, but as your own personal unpaid staff. When a ruthless algorithmic manager at a corporation optimizes a slow workflow, it directly enriches the corporate shareholders. When you independently optimize your own workflow, it directly enriches you. That is the fundamental difference in capital allocation. You are arbitraging the massive knowledge gap between the sheer speed of AI and the broader market's current misunderstanding of it.
So here is the highly practical, actionable 4-step framework. Listen closely. Step 1, rigidly identify a digital service that modern businesses desperately need but absolutely hate doing themselves. This could be deep data analysis, automated outbound marketing, complex technical writing, or CRM integration. You must find the pain point.
For example, businesses constantly struggle with keeping their customer data clean and actionable. They hate exporting messy lists from Shopify and trying to figure out who is about to churn. That is a massive pain point with high financial stakes.
Exactly. Which brings us to step 2. Systematically build a workflow using AI tools to do roughly 80% of the heavy computational lifting. You do not manually write the code or the copy from scratch. You do not manually clean the Shopify data. You build a stack. You use an integration tool like Zapier to pull the data. You feed it securely into an LLM via the OpenAI API to analyze purchasing anomalies. And you have it automatically output a predictive churn report. You strictly verify and polish the final result. You are the director. The AI is the production team.
Step 3, perfectly package that final outcome. You do not ever sell hourly packages, never sell your finite time. You sell a completed, tangible project. You charge a premium for the guaranteed result, not the sweat it took to get there. If a desperate company will gladly pay $2,000 for a comprehensive market report that saves them $50,000 in lost subscriptions, they genuinely do not care if it took you 40 agonizing hours or 4 hours with an AI assistant. They just want the high-quality report delivered on time.
Value-based pricing is the only way to scale wealth. Step 4, build your own digital distribution pipeline. You need a frictionless platform to seamlessly connect your highly leveraged output with the corporate capital that desperately wants to buy it. You need an established marketplace where you can bypass the algorithmic corporate managers entirely and own the direct client relationship.
This is exactly where you have to set up your digital infrastructure immediately. You need a massive global storefront where serious businesses are already actively spending heavy capital. We see Fiverr used extensively for this exact transition, but people completely misunderstand the mechanics of it. They falsely think it's strictly for amateur, low-quality design work from 2015.
That is obsolete thinking. It's actually a massive B2B ecosystem where serious corporate capital changes hands daily for highly specialized AI-leveraged services. It gives you instant, unparalleled access to global corporate demand without forcing you to spend thousands of dollars on speculative Facebook advertising or cold calling gatekeepers.
The platform simplifies the transition by providing the secure transaction infrastructure you need to bypass those corporate bottlenecks. We've put the official verified links in the pinned comment below. Don't go searching randomly and get scammed. Use the ones we've checked.
Your final actionable advice: set up your professional profile today strictly as an AI automation agency. Position yourself clearly as the ultimate solution to their bloated operational overhead problems. Treat it as your most valuable piece of digital real estate. Aggressively optimize your gigs to sell final outcomes, let the AI successfully handle the heavy data processing, and start stacking real capital on your own terms.
You cannot save your way to wealth on a monitored salary. You have to step entirely outside the optimization loop.
Don't let the future leave you behind. Start earning.